What does the future hold for commercial real estate? Whether you're an investor, developer, or just curious about the CRE market, then pay attention because in this video, I'll break down the top 3 trends in commercial real estate, why they matter, and how they'll shape the industry moving forward. After watching this, you'll be armed with the knowledge to stay ahead of the curve in the rapidly evolving market. My name is Bishoy Habib, and I'm the realest real estate attorney you know. Over the past 12 years, I've closed over 1,000 transactions totaling $12 billion. I've seen firsthand how market trends affect deals and opportunities, and the investors that see what's coming up first are the ones who cake up. So let's get into it. Trend number 1, alternative asset classes are outperforming traditional CRE. Let's talk about the dramatic shift happening in investor appetite. Remember when office buildings were considered the safest bet in commercial real estate? Maybe you don't remember, because it feels like forever ago. That world is now gone. Data centers are exploding right now, with analysts projecting they'll need $500 billion financing over the next 5 years. That's nearly $500 billion, trillion with a T, flowing into a sector that barely registered on most investors' radar just a few years ago. Why? Our entire digital existence, from Netflix to Zoom calls to AI, runs through these facilities. I recently saw a deal where a former shopping center mall was converted into a data center, and it now generates 4 times the revenue per square foot than when it was retail. But here's the catch most people don't realize. Finding enough power to support these facilities is becoming a major roadblock, probably the biggest one in my opinion. In some markets, you can secure the land and financing, but you still wait years for the necessary power infrastructure. Meanwhile, traditional office space faces a reckoning. It's like a tale of 2 worlds. I had 2 clients with nearly identical office buildings in the same submarket. The one who renovated with high quality collaborative spaces and flexible configurations and all the amenities and perks, they're at 94% occupancy. The other one refused to adapt and is struggling with 52% occupancy. They have declining rents and nobody really wants to go there. The market is now ruthlessly separating winners from losers with no middle ground. If you're still evaluating commercial real estate the way you did 5 years ago, you're using an outdated playbook that could lead to disastrous results. The investors who understand this divergence between asset classes are finding opportunities while others are caught flat-footed. Trend number 2, AI integration. Next, let's talk about what everyone wants to talk about, artificial intelligence. But not just because it's a buzzword, it's creating a competitive moat between industry leaders and everyone else. Here's what's fascinating. We're still in the early innings. Most companies are using AI for narrowly focused tasks like lease abstraction, document processing, and maintenance predictions. Think of it like this. Remember when websites first became a thing? So at first, only the most forward-thinking businesses had them. They didn't really feel like they were necessary. But soon after that, everyone needed one to compete. And nowadays, if you don't have a website, you're not going to get any business. Everyone's going to look at you kind of funny. That's where AI stands in commercial real estate right now. It's not fully mainstream yet, but it's rapidly becoming more and more essential. Let me give you a concrete example. I worked with 2 property management companies last year. One implemented AI tools to analyze their maintenance requests, predict equipment failures, and optimize their staffing. And they cut their operating expenses by 12% while improving tenant satisfaction. The other company stuck with traditional methods. Not only are their costs higher, but they've lost 3 major contracts to competitors who can demonstrate better efficiency and responsiveness. It's not just about cutting costs or being trendy, it's about creating entirely new business models and revenue streams that weren't possible before. The gap between leaders and laggards is widening every quarter. Trend number 3 is Florida's explosive growth. Finally, let's zoom in on Florida. Not just because it's where I live, but because what's happening here is a microcosm of regional opportunities and challenges nationwide. The population growth that we've seen over the past few years is staggering and has created enormous demand pressures across all sectors of real estate, especially affordable housing, which I think is our #1 issue here in the state of Florida, probably right ahead of transportation, which we are terrible at. But it's not all sunshine and opportunity. Last month, I met with a developer who had to completely redesign a multifamily project right here in Tampa because insurance premiums had increased 340% from initial estimates. You heard me correctly. The insurance premiums tripled from the time they started looking at this project. That's partially because of these hurricanes, partially because all these insurance carriers are leaving the state, partially because of all the lawsuits tied to the insurance claims. There's a lot going on here, and this is a major issue that Florida has to deal with. But we're seeing double and triple the insurance costs. This is the same scenario that a lot of people are seeing. Whether you're developing or buying, some of the deals can't pencil because of these costs. So this fundamentally changes the financial calculus for developments. The good news is that initiatives like the Live Local Act are creating targeted opportunities. For those who don't know, the Live Local Act is legislation that allows multifamily developers to bypass certain zoning restrictions if they include affordable units. I recently heard about a client who secured approval for a project that added 40% more units than would have been possible without the program. And so they significantly impacted the economics of the deal by doing it Live Local and adding the affordable units. So it was a win-win. And I've heard great things about the Live Local Act. I'll cut another video about this, but they're basically trying to make sure that terms are more defined and leaving less discretion to the municipalities and cities and trying to standardize it on a state level. That's the feedback I'm hearing from developers. Now in Florida, infrastructure is another critical factor. Some areas are reaching capacity limits on water, sewer, and transportation systems. I mean, think about it. We didn't expect these millions of people to come in during COVID, so we just weren't prepared. I watched an otherwise solid retail development get shelved indefinitely because the local infrastructure simply couldn't support the additional capacity. Smart investors are now looking beyond the property itself to understand the broader infrastructure context. What's particularly interesting is how these trends are reshaping investment flows. Institutional capital that traditionally focused on gateway markets like New York and San Fran are increasingly targeting Florida submarkets, especially South Florida, Miami, and Tampa. This is driving up competition for prime assets while creating opportunities in emerging areas where the big players haven't yet discovered. It's happening though in real time. So what does this mean for you? First of all, be honest about your existing portfolio. Traditional assets that thrived in the past may become liabilities without significant repositioning and investment. Office, I'm looking at you. Second, recognize that the knowledge gap between market leaders and followers is widening. Staying informed isn't an option anymore, it's a requirement. For your investment strategy, consider allocating a portion of your portfolio to emerging asset classes, even if it's just a hedge. Be skeptical of any opportunity that doesn't explicitly address changing work patterns and technology integration. I know we're going back to office in a lot of cases, but there's something to be said about this technology, about people working remotely. There's some balance there. There's two camps and they're extreme, and one says we're going right back to where we were and one says we're never going back. And I think the truth is somewhere in the middle. So make sure you account for that in your investments. And most importantly, dig deeper into local infrastructure capabilities before committing any major investment. For example, what looks like a slam dunk warehouse investment that you're going to turn into a data center might not be a good investment if the local power grid can't support the additional load that modern e-commerce fulfillment requires. In commercial real estate, the most successful investors don't necessarily hit home runs every time, but what they do best is avoid disasters. The market is rapidly evolving, and conventional wisdom, even from a few years ago, may be no longer applicable. If you found these insights valuable, make sure you like and subscribe for more content that cuts through the noise and gives you the real story on what's happening in real estate. Thanks for watching, and I'll see you in the next video.